the uncertainty always fuels the rally. You know, it seems that the markets take uncertainty as a reason to take on risk, really, because if there's too much uncertainty, eventually the Fed and other central banks, as well as fiscal policy, will respond and will take action with more stimulus coming. But I think what happened yesterday and the days before is there's some uncertainty about that stimulus, right? We may get a truncated spending bill from Washington. It's not entirely clear what's the next action from the Federal Reserve when it comes to this inflation target and how to proceed with that. So I think the market took a step back here and sort of reassesses, like, the economy is recovering, but we need more stimulus. And when is that stimulus coming? I think that's the question in the market.
So if there is a desire for more stimulus, we know that the Fed stands ready to provide more monetary accommodation if it's necessary. We know that the fiscal side of things is being addressed by Congress and President Trump and his administration right now. How much more continues the rally? What does the market need to see coming out of Washington, D.C., both at the Fed and out of Congress, to make this rally continue?
I think what's important are two things. One, the markets want to be assured that we're not going to go back to the scenario from June into July when we had the reopening and then had to be rolled back because we cannot control the virus. That is, I think, a really important other aspect of the rally from here. If we're going to get a policy that's too much focused on trying to manage the virus, except the economy, then that's going to be an issue. The other part, of course, is that we are needing more fiscal stimulus to support consumer spending, and to let this fiscal cliff happen, could hit spending quite hard in the fourth quarter. So that, I think, is the bridge the market's looking at while the Fed has covered all the liquidity in the markets. So I think this is what markets will focus on. If the spending bill turns out to be too truncated, too small, then that could be a negative for markets.
It seems counterintuitive to think of rising interest rates, me paying more in interest for borrowing, as a reason to be optimistic. But people were optimistic because the path of interest rates seemed to be making a turn. Can we believe that turn? Are we going to see higher interest rates gradually over time, or do you think we still need to make new lows here?
I think there's a normalization that has started, and it's a very gradual one, because the recovery is on its way. I mean, it's not something that is, let's say, really derailed by the virus such that we are falling back into a recession. If that was the case, the equity market would be where it is today, despite the strength of the tech sector. So yields are low. They're in sort of a range here. I would expect that if we get through the third, fourth quarter, that some normalization of interest rates happen. Say the 10-year reaches the 1% level again. That's still extraordinarily low. But I don't think that we're going to go back all the way to, say, the Fed funds rate, where the 10-year would trade on top of the Fed funds rate. That would imply a next recession. The economy has got stronger, so I don't think that that's the risk from here.